All right, good afternoon, everyone. Welcome back to Wook Capital Management's weekly Wook and Review broadcast. This is our 22nd edition of the Wook and Review. This is Wook Capital Management's Managing Director, Rod Alsman, and I'm joined by our social media manager, Joe Fonicello. And we are going to be walking through this week's newsletter, which was distributed to anyone who has signed up for it. If you are not currently signed up for it, please check out the link right here in the Wook Capital profile on Twitter. Be sure to follow the account if you're not already to ensure that you get that in your inbox every Friday morning. And just need to get a disclaimer out of the way before we get into the content. So I want everyone to be aware that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay, so it was a fun week this week. The Bulls are back, baby. After non-voting member Bostic yesterday set things in motion. So let me go ahead and get my screen shared. And again, we're going to obviously have audio only on Twitter. If you want to view visuals, you're welcome to do so on our in our Discord, wook.gg. So, all right, I have the Wook and Review up on my screen. We're going to walk through that. Kind of talk through each of the discussion points. We have 4 for this week. We're going to talk through the Tesla Investor Day a little bit, talk about NVIDIA's share offering, talk about the peculiarities that are ongoing with AMC, and talk a little bit about some economic data. So a few updates. We did complete our 4th Wook Book Club on Tuesday night. We talked about the themes and learnings from Morgan Housel's The Psychology of Money. The replay is available on our YouTube channel. If you were to just Google Wook Capital YouTube, should bring you right there. It's about a 2-hour recording, if I recall correctly, and we certainly welcome you to check that out. We didn't publish the full book list for the balance of the year yet, but we are sharing what March's book is going to be. It's going to be Joel Greenblatt's The Little Book That Beats the Market. So as we've previously communicated, those calls will be on the last Tuesday of the month at 8 p.m. Eastern. So March 28th, we'll be back on Twitter Spaces talking about the themes and learnings from Greenblatt's The Little Book That Beats the Market, which personally I have not read. I have heard great things about it from those who have read it and from what those on the internet have to say about it. So it's an approachable read is the feedback. It's written at a very easily approachable level. But you don't need to be a math genius to understand the concepts in the book. So I'm looking forward to that conversation on March 28th as we continue our book club series. A couple of other items. One in particular, we'd made mention of this, and we're excited that we're sharing the first version of our Wookie watch list. We've conducted a few surveys over the last 12 months. Obviously, we really just got our social programming underway in the fall. We had a few pieces of programming earlier in 2022, but this is in direct response from Wookie feedback, members of our social community who shared different securities they wanted to discuss more. So we also heard, and as we've mentioned previously, the feedback that folks would prefer to be more oriented on single security analysis rather than so much macro discussion. So this is in line with the feedback that we've heard there. So I have the watch list in the newsletter. I'll read off the ticker, or I'll read off the companies rather. It's a little under 20 companies. Again, this just to make sure everyone is 100% clear. This is absolutely not a recommendation at all to buy, sell, or anything regarding these securities. These are specifically securities that empirically we found are interesting to our community. So we're going to talk about them. We're going to use them as the basis for our single stock analysis and bull versus bear spaces series that we're looking to kick off in short order here. So as always, you need to do your own due diligence. These companies may or may not represent attractive investment opportunities. We are simply going to host discussions on them. So Airbnb, AMC, Alibaba, Bed Bath Beyond, Costco, Dole, Ethereum, GameStop, Robinhood, Lucid, Motor, Lyft, Meta, aka Facebook, Pinterest, Palantir, Tencent, SoFi, and Tesla. So if you have any deep insight into any of those securities, please don't hesitate to reach out and share in the Discord or with us on Twitter. We would absolutely welcome you if you have a particular bullish or bearish thesis on any of these companies to let us know, either DM the Wook handle or Rod's handle on Twitter or in Discord, and we would be happy to get you involved in our forthcoming bull versus bear programming on these different companies. So excited about that. We're going to obviously talk about a few of those companies today in the context of this week's newsletter. And yeah, as we tried out last week, we went topic by topic and spent some time on the discussion for each topic as opposed to walking all the way through. So we'll go topic by topic again this week. I think it worked better. I think it was a better conversation. And as always, we genuinely appreciate your feedback. We're not doing this to make money directly. We're not selling you a product or service. We're really just looking to learn and grow and all become better investors and hopefully unlock some alpha through some good crowdsourced research together in time. So with that all out of the way, I'll get things going into our first topic. Tesla had their investor day earlier this week, and I made note in the newsletter that the company had added over $300 billion in market cap to start the year off. And a big driver of that was retail investor a buying frenzy. The data show that out of every security in the market, Tesla really saw more retail inflows than the other top 5 or 10 combined. So it's empirically a fact that there were massive retail inflows into Tesla to start the year. So it shouldn't be that much of a surprise that when Investor Day came about on Wednesday night and there really wasn't meaningful new information, the share price declined yesterday, even though yesterday, of course, after, as I mentioned, Bostic's comments on a potential pause in the summer seems to have triggered the algorithms to shift. We got a technical bounce off of the 200-day moving average in the S&P. So Tesla underperformed yesterday, the indices, after that Wednesday Investor Day. And to be quite honest, I haven't even looked at Tesla's stock. I'll look at it now. It looks like it closed up nicely today. So over the last 5 days, though, it's still down 2.2%. Whereas if we look at, say, the NASDAQ, the S&P, and the Dow Jones, they're all up around 2 or more percent. So outperformance year to date for Tesla, driven by a lot of those retail inflows, underperformance in the near term because really the price front ran reality. The news from the event was really oriented around reaffirming Elon Musk's aspirational goals for the company, which, as the company maintains, aspirational goals are not fraud. So we heard little detail on what the next generation EV model is going to be. We got a little bit of, I guess, indirect detail on how much less expensive they believe that the car will be able to be produced, and therefore perhaps they'll be able to reach that $25,000 price point that has been publicized for some time and that Musk has mentioned previously. But I think this kind of captures the essence of the entire conversation from the Tesla design chief. Quote, "I'd love to really show you what I mean and unveil the next gen car, but you're going to have to trust me on that until a later date. So just like all things Tesla, you need to trust them, and maybe they'll deliver eventually. And they have delivered, of course, on some of their promises, and they've done quite well over the last few years, as we know. But really, all we got out of them on Wednesday seems to have been this refinery that they'll be building for lithium refining in Texas, and this Mexican assembly plant that they're going to be building in Monterrey. So those are the two major pieces of news that I took away. I saw obviously Tesla kind of, it seemed like it was more of a victory lap than any real this is specificity around what is coming next and when. That they made valid points about some of the cost takeouts, the improvements they've made in their technology, et cetera, et cetera. So I'm going to add up the Wook folks as speakers, and anyone who'd like to chime in on the Tesla topic, please feel free to come up, put your hand up, be a speaker. So Joe, JP, Han, what do you guys have thoughts on this whole Tesla investor?
Yeah, I sent out a tweet earlier today on the Wook account with a clip of Elon at the investor day, and I don't know, the whole shtick seems to be getting a little old, and I think investors feel that way. I mean, you saw the way the price reacted to the investor day, and it wasn't well. So if you watch the clip, I think it's about 22 seconds long, you can just get a feel for Elon's desperation when he says, this is Master Plan 3.
Yeah, and the Wall Street Journal reporting kind of notes that the master plan that you just mentioned is effectively simply him elaborating on Tesla's mission has been to accelerate the world's transition to sustainable energy. So that's what Master Plan 3 is. Not much specificity, but they're going to do it. They're going to do it, Joe. As the vice president once said, we did it, Joe.
I'm excited to see it happen. So we brought up Never Right. Let's see what he has to say. Never.
Yeah, Never Right. Go ahead.
Muted. You don't have to say anything though if you don't want to.
Okay. Okay. Well, I'm surprised nobody wants to talk about Tesla, but that's fine. We can keep going. If not.
Yeah. Oh, sorry about that. Hey, quick question. Do you think of investors were anticipating Tesla to talk about releasing a new model? Do you think if they weren't anticipating that, do you think the price action wouldn't have been so bad the next day?
I mean, it's really hard to say because on my screen, for those who are in the Discord and can see, I have the Wall Street Journal article with data from VandaTrack. And Joe, I had DM'd you another. Okay, you have it pinned. So the second pin has one of the kind of visuals that show just how extraordinary the inflows from retail investors. And look, I've not ever spoken with VandaTrack, so I don't have any deep insight into how they aggregate this data, which brokers they have relationships with, et cetera. So I can't answer any questions around that. I know that whether it's Bloomberg, Wall Street Journal, they seem to be the one who is used by those media outlets as the source for retail investor inflows and outflows. And you can see on Buck's pin, you were seeing daily inflows of hundreds of millions of dollars, to start out the year, which compared to the preceding couple of years, it just pales in comparison. So to your point, were investors disappointed that there wasn't a model announcement? I mean, it just seemed like there was some rank speculation leading up to the event. And I don't know that there was anything the company could have done that would have met those expectations. When you add multiple hundreds of billions of dollars off nothing, and then you don't really get anything, it makes sense it would give some back. But of course, Tesla, it trades very much like a token, and it will probably continue to do that for years to come, as it has for years already. So I think it's just hard to directly connect fundamentals with Tesla at times, but but we can at least observe the retail inflows. And clearly, again, this is, for example, from the Wall Street Journal through March 1st, which was obviously the day of the announcement. The net retail stock purchases over the 5 trading days through March 1st, you saw Tesla take in over $2 billion of retail inflow. Whereas if you add up the entire inflow from NVIDIA, Apple, AMD, Amazon, Meta, Alibaba, Alphabet, Rivian, Microsoft, it doesn't even add up to that. So it just goes to show you how extraordinary the sheer quantity of money continues to flow in, as Elon Musk has proven himself to be the world's greatest fundraiser in history. And he has yet to suffer repercussions for promises that go awry. So we will see how long that continues.
Hey, another thing. What do you think about the
Okay, I don't know if that's
the 10-year
true. I
and
mean,
the
look
dollar?
at
Do you think they're gonna
what happened with Twitter. I'd
continue?
say promises that went not so well. Maybe he has suffered some consequences there. Can't say he's added meaningfully.
Oh, he's the world's richest man again.
Just right.
So,
Hey, do you guys think the dollar and the yields are going to continue coming down to continue the rally, or do you think this is just one-off?
do I think bond yields will go down? I guess which part of the curve? Because I actually don't think we've seen the highs for yields, although it seems like equity market participants hope that's not true. It seems like the economy. We talked a little bit on Wednesday about this during our open mic. The economy is proving itself to be much stronger, I think, than people had thought heading into 23. Granted, we've not seen the full effect of the rapid tightening from extraordinarily loose monetary policy to modestly restrictive monetary policy where we sit today. So I actually am inclined to think that higher for longer, which markets started pricing in more of over the last really month since that blowout January jobs report, will hold true. I think the dollar strengthens, rates go higher. That's I don't have any personal meaningful bets, I guess, in line with that, but generally speaking, that's my view. Chris, I see your hand up if you'd like to chime in.
Yeah, are we still talking about Tesla?
The question wasn't about Tesla, but I'd like to talk about Tesla.
I remember you were asking if there's anybody else that wants to has anything to say about Tesla. I think one thing that we saw from yesterday that we didn't see before was this man named Tom Zhu. Tom Zhu, and he's the CEO of Tesla China, Tesla CN, and I don't know if many of you are familiar with him, but he's kind of a notorious figure in the company. He was responsible for a lot of their expansion in 2020, especially 2019, 2020, as they grew in China very fast. In terms of running the company, getting on people's necks and stuff. So to see him speak publicly, I think maybe it's meaningful. Some people are saying maybe he'll get the CEO position. And I don't know if that's bullish or bearish, but I mean, it's definitely something new that we haven't seen before.
And I also know that he noted they anticipate manufacturing or completing the building of that manufacturing site in Mexico faster than the Shanghai site. Or at least, I don't know if that's a stretch goal. I don't know how achievable that is. Obviously, they've continued to tout for some time what they believe is a competitive advantage in their manufacturing process. So he was, of course, the one who oversaw the Shanghai site. Now I believe he'll be overseeing the Monterrey site, if I have it right.
Yeah, I think they'll just go wherever the benefits go, right? Whichever government will give them the most cash, they're flexible.
Yeah, and Mexico has historically been a really attractive. I mean, with now the USMCA adapted version of NAFTA, locating assembly in Mexico from a labor cost perspective, and thus you're in Monterrey, you're not far from the border crossing at Laredo in Texas. I don't know, to your point about how attractive the offers from that particular Mexican state were to locate the facility there. But Tesla's certainly not the only mega cap that takes as much advantage as possible about those attractive tax incentives. But it is interesting your point about, and I'm reading, kind of in what the article had to say that I linked in the newsletter, talking about Elon emphasizing the bench strength, having 16 executives on stage for the Q&A. Elon has like a delicate kind of transition because clearly a large slew of investors are buying Tesla, thinking they're buying all things Elon Musk, and eventually Elon Musk, it seems, is positioning himself to step away in some capacity from Tesla. So it will be interesting to observe what happens, if someone else becomes CEO. Will there be any changes to the way in which the meme, I guess, trades? Right? It's obviously the way the stock trades is not always connected to the underlying business, but it will be interesting to observe that.
Yeah, I mean, he could become chairman, or he could stay chairman and not be CEO, and like have like a Ryan Cohen type of deal where he's not as involved in the company, but he's still there for retail investors to kind of like point to and say, hey, he's with us.
Yeah, and I know, Steve, you're coming up, but before you do, and Never Right, sorry, I see your hand, so I'll let you go. But I've made the point in the past, and I think it's still true, that Elon Musk represents the single largest key man risk or key person risk that's ever existed in financial markets, right? If something were to happen to Elon Musk, the next day Tesla stock would likely lose many tens of billions, if not $100 billion plus of market cap, because so much of the perception and the valuation seems to be around Elon Musk and his perception that he can do anything. So that they obviously don't want that key man risk to be so large, but it'll be curious to see how the transition plan works out. But Never Right, please go ahead.
Yeah, I was wondering, does anybody think like Tesla is pulling forward their sales with their price cut?
Yes.
Do you think that's going to affect them in the second half?
I think so.
All right, thanks.
So I'm going to just pull up what the analyst trends look like for earnings. So again, it's interesting, right? For fiscal year 23, so the year we're in, heading into the year, the EPS estimate from sell side was about 5.50 per share, and now it's been slashed to just under $4 per share, so 3.98 looks like the current consensus. So it's just very, again, you typically, it just kind of highlights what the point I keep making about how extraordinary the retail inflows into Tesla have been in light of a deteriorating outlook, analysts meaningfully marking down 23, 24, 25 outlook. You usually wouldn't see such a rapid, I guess, inflow of capital when the outlook's deteriorating. But Tesla just is its own magical unicorn beast, and can't stop, won't stop. Okay, I think that's enough Tesla for one day. We can circle back when we get through the other topics to any topics folks want to pick on a little bit more. The second item for this week's newsletter I had included on AMC. So of course AMC is one of the other meme stocks, and it's funny, right? You get quarterly earnings, and clearly it doesn't trade, again, very connected to those underlying earnings, but box office results in 22 were, broadly, I think, disappointing, and the company's fourth quarter results were fairly disappointing. But I guess the more peculiar part, and the reason why I felt like including it, is this ongoing litigation regarding its preferred stock scheme that it has going on. So So I guess I'll read a couple quotes off. Adam Aaron, the CEO, noted Tuesday during the call that they basically have an initiative where, if folks remember, back in 2022, the company had come up on its authorized share count cap, so they could not issue incremental common stock because they needed a shareholder vote to raise that limit. The company creatively came up with APE, which was AMC preferred equity units, which are a preferred stock unit. It is just like the common stock in terms of its voting rights and its rights for dividends. Not that there will ever be an AMC dividend, but the company was able to use the preferred stock. And we talked about this last week, not pertaining to AMC, but just pertaining to all these interesting preferred stock schemes that companies have been using, especially meme stock companies who have a high mix of retail owners who typically don't participate in shareholder actions and shareholder votes. So they required a majority of outstanding shares to vote yes, which even if, say, half the shares voted and 90% of those shares were to vote yes, that 90% of 50% would only be 45%, which wouldn't get you a majority vote, right? So because you don't have voting frequency from the retail holders, typically it creates this conundrum. So their creative way to get around this and others is to kind of give preferred stock, whether you kind of on a pro rata basis make all the people who do vote out of the preferred stock population. So if 10 of the 100 vote, but 9 of those 10 vote yes, then 90 of the 100 preferred stock shares units would be a yes vote, if that makes sense. So in a nutshell, they have this court case now where some of the common stockholders are basically in court trying to argue that this shouldn't go forward. But the point that it really boils down to is if that were to fail and the company can't sell more common stock, then they're just going to sell more apes. And the common stock trade at a much higher price than the ape units. So it would be much more dilutive for the company actually to issue more apes at a significant discount to AMC common stock. So it's just this very, very peculiar situation again, where what is the right thing? It depends who you are and how you're positioned. From a pure corporate finance perspective, right? The company obviously still has a lot of debt, and it's accretive to the company to sell equity at these valuations. But it would, of course, be more dilutive to sell more of the preferred equity units. So it's interesting. I find it interesting, and it continues to be a topic that Matt Levin talks about in many of his money stuff write-ups, which I read often, and I find just trying to learn, right? So I don't know if anyone has any thoughts on what's going on with AMC. Do they think that the court will allow the preferred equity unit vote to proceed the way they want it to, or if it blocks it, right, then the company still has to sell more equity, which it will sell through APE as opposed to AMC. So it's just, I don't know if anyone has any thoughts on it. It's one of the wonders of post-meme world we live in.
Yeah, I think the funny thing about this meme stock phenomenon is that if there's this huge elephant in the room, and that's the thing, these countries are these companies are very highly indebted usually, right? They're highly leveraged, right, which makes them very volatile. But I mean, there's this huge elephant in the room is the debt holders, and usually in these articles you don't really hear much about them, but who are these people? A lot of them are big banks, right? Either if they're floating rate credit facilities or they're paper, right? They're convertible debt or just regular fixed rate debt. But these guys have to get paid, and they'll do whatever they can, right, to get paid. So, I mean, I think this whole scheme with preferred shares is just a method, right, for them to get what they're legally entitled to.
Yeah, I'm looking at FINRA again. If you're in the Discord, you can follow my screen. The yields on their junk rated debt, it looks like it ranges from the low to mid 30s% yield right now, depending on which bond we're talking about. So it's still pretty distressed. I haven't been following the bond side of AMC too closely. I don't. I think there's other places to invest one's mental energy. It's more fruitful. But you're right. I mean, the bondholders are in front of equity. If they were to file some sort of restructuring, they would have had to file a restructuring if it weren't for the apes, right? The apes have kept the company from having to restructure and file a Chapter 11, whatever. But the underlying business, as I noted, is not healthy. While they did report an adjusted EBITDA figure in the fourth quarter, it's not as though on a net basis they're generating cash for the business, and they still have a lot of debt, like you noted, a lot of interest. So okay, your EBITDA is positive, but then interest is a real expense. CapEx is a real expense, right? There's only so long they could go without retrofitting or replacing the projectors in their theaters, for example. So I don't know. I don't know how it resolves itself. Will they continue to just dilute for coming years? If the apes never leave, then I don't see why not. But never right. Yeah, your hand's up. Go ahead.
Yeah, can you elaborate on the ape conversion to the AMC stock? Is that still going to go through? Like, I think it's scheduled for like March 14.
So I have on my screen, Matt. It was the 228 money stuff, where the headline was AMC's apes have to wait, and the shareholder vote to approve the conversion is scheduled for March 14th. However, some shareholders sued, claiming that this is a trick to get around the charter, which it is, but from a legal perspective, I guess that's the question. So the vote will go on as scheduled on March 14th. Whether or not that vote is won, it won't immediately amend the charter. Instead, that vote will wait for this court hearing, which will be on April 27th. So that was the event that transpired this week, where because you have a lot of folks, right? There's an arbitrage opportunity here, right? The all else equal, there should be, if there were one ape for every one AMC, which there's now more apes due to dilution, but for simplicity's sake, if there were one ape for every one AMC, they should trade at the same price because functionally they're the same thing. However, what happened was the retail investors who received the apes in distribution seemingly didn't like the apes. They sold the apes. Ape then traded at a meaningful discount to AMC common stock. And there was an arbitrage opportunity for, there's at least one hedge fund, the one who's named, I think it's Antera, who bought a lot of ape with the view that, if we move ahead with this conversion where they approve the issuance of more common stock, the ape gets folded back in, so the price of ape would be forced to rise, and they could realize a return. So they would be, say, long ape and short AMC, and a lot of people were clearly in that trade, and that's why earlier this week, when this court date got pushed out, or rather this decision got pushed out to late April, you saw the price, Monday it opened at 631 AMC common stock. It skyrocketed, over $8 at points on Tuesday after this result, because clearly some of those funds are probably getting squeezed. They decided to close out the position. Maybe they decided the cost of the carry, wasn't worth it to them anymore. I'm speculating. I'm obviously not privy to their thinking or conversations, but like that's what's going on with the whole AMC and ape thing. It's you have sophisticated market participants that are trying to arbitrage this irrational on its face kind of price gap between the two securities. And it's unfortunate because a lot of people just are shouting crime and they don't realize maybe what's going on. But we'll have to wait another almost 2 months to see what the court decides on if this is permissible or not. So it'll stay entertaining. Get your AMC popcorn ready.
3 new flavors of popcorn.
There you go. Yeah, so I don't know if anybody has any other thoughts on the whole AMC situation. I know we mentioned it'll be on the watch list. We'll people want to cover it and talk about it, so we will do so. But the business itself, right? It's when it boils down to it, it's the movie business has still been challenged post-COVID, right? Box office receipts, I know we're still lagging pre-COVID levels meaningfully. You can what is it? I know IMDb has some box office data. Like I don't follow this stuff all that closely, but I know Ant-Man and the Wasp. Obviously, this is not part of fourth quarter, but it just came out, and it was the worst MCU film yet, right? Obviously, Avatar done really well, but the business itself is seemingly challenged, and it's like, will it ever get back to where it was? Maybe. But even so, the company is burdened with meaningfully more debt, which means that even if it got back toward that level, it shouldn't be trading at such a massive premium to where it was pre-COVID. But that's just my take.
Did you listen to the earnings call this week?
I did not.
It was very, very entertaining. I highly recommend. I had a good laugh.
What in particular?
They had one analyst call in. I've been posting a recording of it online.
It was B. Riley. I saw people talking about that. The same folks who underwrote the Bed Bath Death convert. Right?
Yeah, and this guy, he asked this one question. He couldn't hold back his laughter while he was asking this question, and then the CEO, Adam Aron, interrupts his question, right? Because he wants to ask about the movie business, not the popcorn business. And then Adam Aron says, the one thing you'll like more than the popcorn financial results is eating the popcorn. It's really good. We've spent 1 year on designing the flavor profile. It was hilarious. But besides the entertainment, I mean, value, honestly, I can't really think of anything, financially. I think they beat by a few cents EPS and on revenues as well, per share. I don't think there's been a meaningful overperformance or underperformance relative to the earnings results. People are just kind of,
fourth quarter 2022. I'm looking at Koifin data, so just like a couple, I guess, data points. Sales, all the way to the top line, sales were down 15% year over year, 4Q 22 versus 4Q 21. So sequentially, quarter over quarter, they rose like 2%. But it's like, okay, you generated positive adjusted EBITDA, but then back out DA, back out the interest and net income, was a negative. They've been losing hundreds of millions of dollars per quarter on a net basis for a long time now. So while yes, this incoming cash from financing continues to keep them afloat, if that ever stops, unless something magical happens to the business, I just don't see how they survive a restructuring.
Yeah, maybe they can file for bankruptcy so the stock can reach all-time highs.
Yeah, those are the times we live in.
But from the perspective of the debtor, any capital they raised from equity holders is just basically free money. I mean, they can ride this out as long as they want before any eventual filing, right?
Yeah, if this vote passes and they're allowed to increase their common stock issuance authorization, then as long as people keep buying the stock, bidding the stock, then yeah, they can keep selling stock to those folks and pay back their debts with it. Cover their operating costs, which, again, they're still burning money. Free cash flow is negative. It was negative 84 million, it looks like, in the quarter. The projection I see is, it's not like things are going to get better. I guess there would have to be a market improvement in the underlying business to ever justify anything close to these valuations as I see it. But
yeah, I remember when the CEO was on CNBC, and they were asking him why he was issuing like the ape stock, and he said because they ran out of common stock.
yeah,
That was
exactly.
crazy.
Yep.
And then, like, on the earnings call, well, I guess this was interesting. He gave like 7 reasons for why the shareholder should vote yes, and why he thinks he should vote yes. And one of them was, he says that Wall Street is arbitraging our stock, right? And in order for him to stop doing that, we need to vote yes and allow conversion. It was a very bizarre comment to make.
Yeah, I mean, he knows his audience, right? He knows, a lot of the folks who own AMC common stock are under some belief that there's either a massive hidden short interest that they can squeeze or whatever. So certainly he's playing to the base, if you will, thinking about it from a political perspective.
I mean, he's right.
I mean, look,
Right.
to his credit, again, he's been able to entertain shareholders enough to continue raising capital, and some of them like him a lot. I see on his Twitter all these selfies that he, other investors in AMC share with him at different theaters. So again, it's just, there's such a major difference though between an attractive investment and a speculation, and this is clearly a speculation if we go by the financial statements. But some people are opting to put their capital to work here, and that's their right. They can keep doing that, and so long as they do keep doing that, the company's going to stay afloat. But I think that's enough AMC for one day. 2 more topics then. Got the NVDA. So this is also another stock. I mentioned earlier the retail inflows from the data year to date, NVIDIA being up there. And look, we talked about this a lot last week, so I don't want to spend too much time on it, but I thought that it was important to turn around and highlight. I used the headline, I guess, NVIDIA is selling what investors are buying. And NVIDIA had earnings last week, right? We talked about how they mentioned AI so many times in both the release as well as the call. They understand their investor base. They understand what they want. They want more AI. They're going to sell them more AI. They're going to sell AI as a service. And again, I'm not saying AI won't be a real thing. It seems like, from very smart people, smarter than me, that relative to Web3 and crypto, AI has a whole lot more going for it from a real opportunity to drive productivity for people and business. I saw last night, for example, some early reporting. I think the reporting came out yesterday, literally, or the day before. Some research articles kind of showing how much more productive knowledge workers were able to be, in a few examples, leveraging ChatGPT and other language learning models in doing different types of work. So look, if you can improve productivity, then clearly there's a business case to be made for these language learning models and other forms of AI, whether we even get past where we are today. So I'm not saying AI is not real or won't drive good for society, just that, again, how much of the, I guess, benefit is priced into the stock. And from the company's perspective, right, they saw the company rise, 250 billion. As of yesterday, at least, when I wrote this, it was up 63% year to date. And while they said these lovely things last week in their quarterly earnings call, or we got this week instead a $10 billion share, mixed securities shelf offering. So they didn't sell the shares or whether it's warrants or preferred stock or shares, whatever it ends up being. They haven't sold it yet. but they filed this shelf so that they could sell at some point in time. So that tells me as an observer, again, I've never owned NVIDIA stock. I've followed it loosely. I have a rough understanding of the business, but it tells me that management sees the price as elevated, right? If you are selling securities, you typically are doing that when your price is high, hopefully, not when you think your price is low. They noted in the call just preceding the week earlier that they were bought back some stock and had, of course, returned some capital to shareholders via dividends. So they had done like 1.15 billion of that. But then again, fast forward a week with the price where it is, I think it's the right thing for the business from an opportunistic perspective. And the share price didn't react meaningfully, negatively. Obviously, it's not a huge dilution in the context of NVIDIA is a, let's see, what is its market cap today? It's just shy of 600 billion. So 10 billion is less than 2%, right? It's not like it was a huge dilution, but it just goes to show you, they know what they're doing. I think they perceive their price as high, and while it's high, well, let's sell some capital, raise some capital rather at high valuations. And hell, maybe later in the year AI is not as much of a buzz, and maybe they'll just turn around and buy back some stock at a lower valuation. Who knows what's going to happen? But I just thought it was worth highlighting in the context of us having that conversation last week on NVIDIA, and then seeing them do that offering this week. I think it's the smart thing to do, actually, if you're management. But I don't know if anyone has any thoughts on that, or if they want to push back on the perspective I shared.
No, like I'm an NVIDIA shareholder. Like I bought since 2020, and then I bought on the low, and when the company did that, it kind of left a sour taste in my mouth. It kind of the first thing I thought of was AMC when they did that. Like I didn't understand why they did it at that time. It seemed like it was just like they were trying to take advantage of the opportunity, and they were desperate. But it didn't make sense to me. But
well,
another
the price
thing,
is up. The price is up from when they did it.
Yeah, I know, but like that's just a reflection of it's turning into a meme stock. Hey, but how high do you think this price could go? And do you think it's going to and if it goes to like 350, do you think it's going to justify the growth and the growth through AI? Like how many data centers can they build? Or I don't know.
Yeah, Montiv, I know you're in the audience, and this maybe is something and if so, would welcome your insight. And Steve, I see you came up to speak, so please chime in if you have thoughts. I mean, I know I mentioned last week when we talked about it, my view was that I had never been invested in it. Those who have and bought, at any point really, other than I guess the peaks have done quite well. Really, if you bought at any point in the last decade, other than maybe the last year or two, you've done fantastically. But I just don't know how attractive forward returns are, given it. It seems like a lot of that growth is priced in just from a analyst. Not that the sell side analysts are right, but just to kind of point out just how much growth is baked into the current valuation. I see that there's 10 sell side analysts that have a 2026 EPS estimate, and the average for 2026 earnings per share is 764. So yes, sell side expects that earnings per share will grow over 30% for the next 3 years before it starts to slow. But that's a very rich multiple. The current 1 year forward is 54 PE. The 2026 forward PE is 31x. So clearly it's priced for growth. Could there be more growth? I don't know the answer to that to give any high degree of certainty, but I would argue it. If the company's selling stock at these levels, then that doesn't seem like an attractive point to be buying stock. But I've been wrong. I'll be wrong again.
Have you heard anything regarding the effect of the China sanctions on these chip companies like NVIDIA and Intel and whatnot?
I'm not sure.
I think it's like 400 million, like from their bottom line or something on the yearly.
Okay, so that's something. But
the chatter in the valley is that they are kicking some tires, looking at acquisitions. That's why they put out that mixed shelf offering. I don't think they need the money for running their business. They're doing fine there. They are talking to a bunch of private companies, is what I hear.
yeah, that's it.
That's why we love having Moneta's boots on the ground. Thank you
Yeah.
for that. Steve, I know you came up. Did you want to chime in?
Yeah, right. So, well, just quick. Well, NVIDIA, I agree with Ross said about capital. I think that's what exactly. I think Law Bath and Beyond should have take notes on that. Like that's what they should have done back a couple quarters ago when they have a lot of liquidity in the markets and trying to do that capital raising. But on that aside, I want to just circle by on Tesla real quick. So if you don't mind, I just want to comment on Tesla.
Sure.
The Investor Day, yeah. So I think the Investor Day itself, as I would say, I mean, it's coming from a lot of expectations, really underwhelming, to say the least. I mean, it seems like the management or the CEO trying to focus on too many things at this current trajectory. If you look at it's last quarter financials, you can see a significant decline in their profit margin that's dragged by the cost of goods and the production costs. And then I think like Tesla's hitting the stage where it's really looking to spending more money on capex and really to finding for next stage of growth. And then the fact that they have this big gap in product rollout, time gap is not really helping. So I would say that the investor did not really, produce the result that most analysts or maybe retail was expecting. And then if you look at in terms of valuation, I think it's interesting. I mean, I was looking at Professor Donoman's valuation on Tesla. I don't know if you guys follow his thesis, and then he got a lot of pushback, when he published his valuation. So basically, he gave a relatively.
He published a new valuation. When was it?
Well, a month ago, right? A month
Okay.
ago. I don't know if that's new. Yeah, he keep updating his valuations. He basically have a profit margin of around like 18, 17.
And he said he found it to be worth 130. Am I looking at the right?
Yeah, 130, 129 something. So determined value about something like that. Yeah. So yeah, I think that was an interesting model he pulled out. I would say it's a story company. Reminds me of Netflix back in the 08, back in the post GFC, where there's not much competitors, and then people just riding the ship. Now you have lots of competitor coming in, and then we're heading towards this global liquidity tightening cycle. It's not. I would say the odds is not on the side in terms in the bigger picture. But I mean, it's an interesting time to for the company to be in.
Yeah, thanks for sharing that, Steve. I'm seeing it, and I've put it up on my screen. He said, quote, "I last valued Tesla in November 2021, just as its stock price was peaking, and I found it overvalued by more than 50%. Back then, he believed Tesla was worth around 640 billion when it was trading at north of $1 trillion. So yeah, it sounds like he still thinks it's overvalued. It's less so than last he did this valuation, but
yeah, and then another thing is not much people are talking about is the new factory in Mexico. So what I heard from people on the ground, like in Mexico, saying that there's some flashback about people saying that there might be some local environmental effect or damage to have there, because apparently they have like water problems in that region. And then the government, in order to bid that, to get them to on board, and then they forced, I don't know, to force the local farmers or business to provide water or something, cut back spending. So I don't know. It's not a lot of people talking about it. It sounds like a lot of PR problem that they might have faced on down the line. But I find that interesting.
Well, thanks for sharing. I hadn't heard that particular issue. I don't follow it supremely close, so that's good insight. I would just add, like, as we shift the conversation back to Tesla, kind of in line with what I was saying in my view on NVIDIA. And again, I'm not really a growth investor, so I guess I always tend to think these things are expensive by my own nature. But I'm looking at the analyst estimates for sales, and I know Tesla has kind of said, yeah, we're going to grow at 50% per year through the end of the decade, but it doesn't look like that's what analysts expect. They expect 26% for 23, 30% for 24, 20% for 25, and there's a couple dozen in that population, so it's a big enough sample size. So it looks like sales growth is going to grow more slowly, is what the analysts see. Which again, just the valuation, clearly, if you think of them like an automaker, it doesn't, and Mr. Professor Demoteran finds it overvalued. I think it's overvalued, but it doesn't matter, right? As long as people continue to buy, it can go as high as it wants to, as it has in the past, despite, again, the multiples being quite rich. And I'm not so certain that their sustainable competitive advantages are as strong as the bulls tend to think. I mean, I've always had the view that the supercharger network was a pretty impressive advantage, and now that it won't be, I'm not so sure what precludes people from buying other electric vehicles who want to be able to do long road trips. But we'll see how it pans out. I mean, it's hard to argue, though, if they delivered a $25,000 purchase price vehicle, when you consider the attractive tax credits built into the Inflation Reduction Act, that it would be hard to argue that for many consumers that wouldn't be a meaningful cost savings versus an internal combustion engine. But right, they need to deliver it, so we'll see when and what it looks like and costs.
Well, the question is, even though if they deliver it, right, with all the competitor in the space, if they can deliver 25,000, why not GM or Volkswagen have the similar model, and then that will come to us customer brand values. Would you buy a GM or you buy a Tesla at the same price point? That's another problem for them to figure out. And then I also go back to your comment on analyst excellent. I think it's just interesting we're still in this loop of sales analysts chasing targets. I mean, when we used to work on sales side, a lot of things we do is kind of copy and paste from competitors. And one thing that I think people, you probably find it funny these days. You can just, like this week, you have this company, Surrogate Capital, the bank. It filed
going concern language.
Yeah, going concern to the SEC, and if you look at 2 years ago, JP Morgan, one of the bank was covering them, and then they were like, "Oh, this is one of the most exciting bank we have discovered, and probably the hyper growth potential."
JP Morgan said that about Carvana too, I think.
Exactly. So, but if you turn to the history book, probably pre-pandemic, if my memory is short, Tesla is not very, loved by the analysts. A lot of people have underweighting on Tesla. It's only because the pandemic, and then people start chasing the price target, and they just keeping buying. I mean, giving credit, the Tesla has developed a lot of generating a lot of revenues on the bottom line, but I just think it's funny because how we are basing on analyst price target, but these price target are really not really, I would say the price target that's really reflecting the current or the future value, what, could be. So just,
I think so. I'm looking at a graphic now of historical analyst price targets, and yeah, clearly analysts actually have never been more bullish on Tesla from a not from a price target perspective, but from a out of 5, right? If a 5 is a strong buy, a 1 is a strong sell, it's never been higher. It's at 3.86 now, so the kind of average is just shy of a buy rating. So, which is interesting, right? I think you're correct, and the data show that historically they were not as highly rated by sell side. So, I agree, though. Often it's just the way that the game works. They're playing catch up, and copying what their peers are saying from a numbers perspective to an extent. So yeah, I mean, I'm using these numbers, and it's not that I am necessarily saying I believe them, right? This is just using it as a one data point. I do not, unfortunately, have right now access to. There's a good paid service out there that we may pay up for later in the year. That gives you some good buy side data, but as an aside, yeah. Right now, the average price target is actually higher than the current price of Tesla. It's showing me 204 as the average, so it closed the gap meaningfully. But you're right. As the share price fell, the price targets fell, and as the share price goes up, the price targets are going to go up. It's just the way that game works.
Yeah. Well, the buy side, there's always the Kathy Wood open source model.
Yes, there is always what ARK publishes. You are right. But okay, yeah, Steve, I know you were trying to come up earlier, and I don't know why the software was glitching and we couldn't add you. So I'm gonna get through, I guess, our last topic, and we can talk more Tesla, AMC, NVIDIA, or any of the related topics. I am gonna probably close the conversation down a little earlier, maybe by 5:30. I do have a commitment this evening, so I do need to just give folks that 25-minute warning. But we talked a little bit about this for anyone who joined our open mic on Wednesday, which ended up going for 5 hours. JP, who's up as I'm going to add him actually as co-host. He did a great job managing that, because we opened our open mic at 7 p.m. on Wednesday night, and I went to go get dinner around 9 p.m. and I said, yeah, I'll leave my phone on in the office and let you guys keep going, because Michael Cantro and some other folks had joined, and eventually the spaces ballooned up to like 300 people as midnight, and I'm like, hey guys, sorry, I have to turn my phone off because I'm going to bed now. Unfortunately, Mr. Musk still hasn't made it so that you can transfer hosting from one person to another. I would have loved to have been able to do that so folks can keep talking. But we talked about this, right? First of the month, you get a lot of good economic data. The Purchasing Managers Index from ISM. I've mentioned this before. When I worked at Ryder, I worked closely with Tim Fiore, who's the chair. He was the chief procurement officer, and I have a lot of respect for Tim. And I would encourage any time that the PMI comes out, you listen to what Tim has to say, because I think he has his pulse on manufacturing as good as anyone. But there's like mixed. It was like a mixed bag, right? You've got what looks like the composite index. When it's less than 50, it means it's contracting. When it's more than 50, it's expanding. And while the composite number was still below 50, the bottom looks like it's in. When you listen to what the survey respondents, the purchasing managers, have to say, it looks like they feel good about the outlook. New orders index, which had been contracting deeply, it's still contracting, but it bounced solidly. And unfortunately, though, the con to that was that the manufacturing prices paid component of the index went from contracting to expanding again. So the sense from what I heard Tim say is that if you're an economy growth bull, demand bull, then this is a good report for you. But if you're the Federal Reserve looking to ensure prices return to stability, then this is not good for you, because manufacturing prices paid are now beginning to rise again. So I think in a nutshell, it just kind of shows this kind of balancing act we keep walking, where you want to see good economic data, but on the other hand, if that economic data is showing that demand is still too hot, for I guess the labor supply that we have, will the Federal Reserve have to do more? And of course, a month ago, that's where the reaction was, wow, you had this really ripping labor report. So, that's when markets finally began pricing in this higher for longer, as opposed to the rate cuts in the back half of the year that they had been pricing. So, I think it just, in a nutshell, I would say the economy seems to be stronger than most folks, especially folks who were saying there's going to be an imminent collapse of sorts, had prognosticated. But you have cons, which are that prices are not declining at the rate that maybe the Fed would have hoped. And granted, we haven't seen the full effect of the tightening, given that they only began tightening not even 12 months ago. So it's going to be a bumpy ride, I guess. But the things are still pretty solid. I don't know if anyone wants to add any other data points they see or push back on that ISM thinking there.
Yeah. Did anybody notice that the prices paid for the services ISM came in lower than expected, and I think that's what pushed the market up today.
The numbers are all over the map. They're not consistent. They're not directionally consistent. And they're not geographically consistent either, right? European numbers came in a little bit lighter. So I think we're going to have to go through these few months of ups and downs, but directionally, inflation is coming down. It's just not coming down fast enough. I think that's the big problem.
Yeah.
Yeah.
Also,
I was going to say that was kind of what Bill, I don't know Bill's last name, but folks know who Bill is, the lovely Patrick Star icon. But Bill made that point, right, that it seems like it's on a trajectory to, return toward maybe 3.5%, 4%, which, okay, then I guess my question is, what is the Fed's reaction function if it looks like inflation is not returning to their stated target of 2%, but it's stalling out at an elevated level? Would their reaction function be to incrementally raise rates further? That would be my gut reaction, but
So
I guess we'll have to see how it plays out.
So Rod, they can always pause and wait to see if anything catches, right? So it's not so the market seems to go between we're going to get a cut or we're going to get a raise. It's there's like a whole slew of options in between. They're still doing QT. They could slow it down or they could speed that up. They could bump up the rate hike, stop the rate hike, continue the rate hike at a slower pace. There's a lot of options. I don't think people want to look at anything in the middle. It's always like, yeah, we're going to have 50 basis points and inflation is going back to double digits, or inflation is coming down to 2% and we are going to get a rate cut, right? Both those ends are unlikely. I think that's always been the problem. We seem to want to go up 10% in a month one way or the other based on what the flavor of the month data is.
And you're right, it's not sexy to be a moderate. It's much more sexy to have an extreme viewpoint, as evidenced by the perma bear spaces seem to get pretty popular, and then the perma bull spaces seem to get pretty popular. The nuanced spaces, the ones I try to host and be involved in, maybe we're a little less popular. People don't like nuance and middle of the roadism.
Just want to comment on the inflation thing real quick. So right now, China is exporting inflation to a lot of developed economy right now. I mean, there's the great timing effect, but I think this type of a cycle is gonna walk through a lot of database and might come up probably in the next set of inflation data, just to keep that in mind.
And just to reply, I guess, never, right, you made correct point that the rate of price increase slowed, but a 66 or 65.6 is still at a very high level, right? So prices are still increasing at a slower rate, which is good. To your point, perhaps that was what market picked up on, but I think Monative is right. It's kind of like a little bit of fits and starts, people seemingly overreacting to one, data point or another. Markets shouldn't, right? Markets shouldn't be seeing price appreciation or depreciation of 10% in a 1 month period. That's not normal. That's not really healthy to me. It would be healthier not to see such huge swings. I think there's still a lot of liquidity, clearly, and just from the different rooms I try to be involved in and monitor, there's still a lot of speculation going on the retail side. I mean, clearly year to date, it surged back, which whether that's making things easier for the Fed, I would argue it's not. But does it matter? At the end of the day, it's probably not enough to move the dial.
Oh, man, I think if the Fed continues going, if the Fed does the 25 and he does another 25 as data, and if data keeps coming in showing that inflation is not slowing down, I don't think the rates are restrictive enough.
That's what Waller said yesterday. I know that they canceled his his actual conversation, unfortunately, because somebody porn bombed the Zoom room. But in the prepared remarks of the speech, it was effectively like he kind of said, look, if the data that came in, which if they're going to be data dependent, they have to be data dependent. And he noted the data that had come in since the last meeting was pretty hot. And if it continued to be hot, he would be in favor of potentially hiking further. I'm sure and he noted there are other members of that viewpoint. So it will be interesting to see in the coming couple weeks. We've got the meeting in less than 3 now, where they stand. I've said this previously. Hopefully, we get to some point this year where the Fed is no longer such an obsession for market participants, and it's not the driving force, and maybe we get back to more of the fundamental economy as opposed to where is the terminal rate and how many more hikes are there and when do they cut, yada yada. But I think we're still in that Fed kind of driving the show, right? I mean, it's hard to ignore what happened yesterday with the algorithms jumping off the pause comment, which, again, if a non-voting member made a point that it may be appropriate to pause in the summer, which is what was already priced. It's not as though that was deeply out of line with what the market had priced. And yet, algorithms clearly were buying the word pause. And we saw what happened through the balance of the day yesterday after the comments made and of course, on today's trading day. And I know there's some folks who are more technical in the room listening, and I would welcome them if they have maybe some technical commentary to add, right? There's the 200-day moving average that a lot of people chime in about. How meaningful that is, I don't know the precise answer, but we can only observe, I guess, what happened. And clearly what happened yesterday was you had a market react very favorably to hearing the word pause, even though, again, as I understand it, he was really saying what was already priced.
Yeah.
Just 15-minute warning, folks, FYI. Sorry, go ahead.
No. I was just gonna agree with you. I think it's still a very trader's market because we are chasing news almost on a daily basis. There isn't enough time to swing trade, though it seemed to work very well since late October to probably end of Jan. But I think we've gone back to this very, very choppy market in Feb, which turns on a dime on sometimes nothing at all, and it's just gonna we're just gonna keep chopping till we get somewhere else, and I don't know what that somewhere else is anymore.
It wouldn't at all surprise me to see the market end near these levels by year end, and possibly even into next year. I mean, it's a little rich. It's not a bubble anymore, I would argue. It was obviously pretty bubbly in 21, and a lot of that air came out in 22.
Dalle homeland, buddy. Dalle homeland.
All right. Well, he's been removed from the space. I'm not sure what he had to share other than his lovely song. But yeah, look, I mean, forward earnings are rich. They're not egregious. If there's no earnings recession and earnings come in flat with 22, then it still feels a little rich. But I can understand, and just because the market is rich doesn't mean there aren't pockets of opportunity. I mean, I noted on my Twitter, my personal Twitter, unrelated to Wook, that there were some international oil and gas opportunities that I've been nibbling on, and I think energy still is a space that, again, even though it had a great run, it was a run off of a multi-decade low base. So energy, there's some spots in energy that seem attractive to me, especially if the economy is going to remain resilient. Then demand for those energy products will remain resilient, and the price levels, right? If you have the federal government saying they're going to replenish, the SPR stores at a certain price point, it puts a little bit of a floor on price. And of course, oil is priced in dollars, and yeah, I mean, that seems like a good area. I know Monatin is a fan of in the industrial space, especially the defense space, because of all the replenishment that has to happen from all the materials that have been sent over to the war, the older materials that now are going to be replaced by newer equipment and ammunition and the like. So there's definitely pockets of opportunity. I'm not at all trying to say the market is going to crash or is in a bubble. It feels rich to me across the board, but you don't have to buy the market if you don't want to.
Yeah, I mean, I'm with you. I don't think buying the market is the trade that's going to sustain over longer than a week or so. I think the real answer is digging far deeper into into parts of a sector, subsector, industry level. There's still plenty of opportunity, right? So based on looking at the earnings season, I've not had time to digest it fully. I just started the work on it, but yeah, cybersecurity has outperformed even now, and growth slowdown is relatively less within tech inside cybersecurity. So that's one industry that I'm still curious about. Valuations are high, but there are plenty of opportunities for for deals and for for merger and acquisition to happen in that space. So that's one I like. You already pointed out defense. Think another area we've seen outperformance is MRO, which is aircraft maintenance. It's a small. It's this very few that's pure plays there. AER may be the closest to it, but Raytheon, Boeing, within their results, have shown that their maintenance business is really doing well, and cash flow generation after the gap of 2.5 years has picked up dramatically. So things like that, I think if you go micro, there's plenty of opportunities to get good, safe, low beta returns, and the rest of it is going to be a trading market, I think. But a sustained swing trade opportunities do exist in this market.
Monative, do you have thoughts on TransDigm? I know it's not an MRO per se, but in that kind of aerospace.
Yeah, I like TransDigm. I have a small position. I got distracted with a untimed entry into
I see they made
something
another
else.
all-time high today.
But I do like TransDigm. They do have defense exposure. They do have commercial exposure. So I do like that space. I like TransDigm in particular. I'll take a deeper look and respond back to you, Rod. I've not really spent too much time. I think I got in a little while ago, and I didn't add to my position at all. It was just a starter.
Yeah, it's an interesting one. They have a lot of leverage. It's one of those few public companies run by guys who have like a PE mindset. So that's an interesting one. They make the seat belts. They make a variety of different components that are in aircraft and the like. But yeah. I mean, you got to dig in, and this is a great time of year. It's March. You got so many 10Ks that are out. I made a joke last night. Are you even reading the risk factors in these companies that you're quote unquote investing in, Anon? You really ought to be at least reading it at bare minimum, right? Reading through those things and understanding what risks the company has. And there's so many new 10Ks coming out, and will keep coming out over the coming weeks. So a lot to stay busy with for finding new opportunities. So it's 5:23. I know we've got a couple other folks who had come up to speak. If anybody wanted to touch on any of the 4 kind of talking points or topics from this week and had any last thoughts, please feel free to chime in. I, as I mentioned, have an obligation in a few minutes that I'll have to shut the space down by 5:30. But just to reiterate for anyone who missed the earlier part of the conversation, you can be sure to follow the Wook Capital handle. We are going to be producing some single stock related content on this initial watch list of companies that was based on feedback from Wookiees. So I have that watch list in the newsletter. You can find all of the newsletters by just clicking the link in our profile with the little newspaper there. And yeah, a lot more to come in the coming weeks. I mentioned our book club read for March is going to be Greenblatt's The Little Book That Beats the Market. So we'll be back talking about the book on March 28th. And we did on Tuesday of this week talk about the psychology of money, and that replay is available on our YouTube channel. So let me pause there, and if anyone wants to chime in with any last thoughts or comments, I don't want to open up a whole new conversation since I have to shut this down shortly, but I'll pause.
Yeah.
Sorry, Steve, go ahead first.
No, you go ahead.
Okay, quickly. Because Bill, in the last space, I had a back and forth with Bill with respect to the health of the economy, right? And I actually found something that is in favor of his argument, because he said that companies look very, very stable. So I found a chart by S&P and by S&P Global, yeah, and they actually showed that historically S&P 500 companies would pay 5% of their revenues. They would pay in interest expenses, yeah, and the last data point was Q4 22, where it was only 1.7%, right? So this actually makes me think, even if interest rates go up, right? Because we are at such a low level. Let's say, okay, that was Q4. Let's say, okay, now we are in March. Let's say it's 2% instead of 5% average, right? So it would still be at relatively low levels, actually, right? So I think Bill might be onto something here. And also next week we will have the non-farm payrolls. Even all the major investment bank economists are predicting unemployment also to stay at 3.4. And the more important thing is the change in non-farm payrolls. The consensus is now that they will add additional job to 215K. And this is way too good in order to be close to a recession, right? And what happened also in the last 6 months, even I would say, is that the non-farm payrolls estimate was always too low, right? So there was always an upside beat. So it's very, very possible that next week we will get around 300,000 additional jobs, maybe, yeah, and then that would actually confirm that the economy is very strong. So I'm actually because I remember last time I spoke with Monetiv, I was very skeptical about the health of the economy. But I would say if next week NFP numbers come in strong, then I might have to slowly change my I have to change my view.
Gerald, I think I don't disagree with the general comment that there are problems, right? There are structural problems. But I think, what you pointed out, right? If you look at interest rate coverage ratios, even wider into, the Russell, it's a difference of feast and famine. There are plenty of companies that have much better balance sheets, but there are also a lot that have worsened. So which is why it becomes important to stock pick. I mean, just picking indexes is going to be a big problem, especially in this market. There are very risky companies out there, and I think they've gotten worse in the last year. But there are companies that have not skipped a beat, and they're chugging along quite fine, and they can, their coverages of their, liabilities are just fine. So I think the point I made back then, and I will still repeat, is this is going to be, about picking the right stocks, the right industries, the right sectors, and riding the strength of, all three, rather than expecting an individual stock to outperform its constituent base, right? That's happened a lot in 2020 and 21 with free money. But historically, most companies, even the leaders, just outperform their industry a little bit. They don't continue to outperform for a long time. So if you have the underlying strength of the industry and the sector, that's a wind on the back, then buying the leaders, you should expect outperformance. And again, right, it pays to be very careful and picky here.
And you can be careful because you can sit in cash and get a pretty hefty yield relative to what you're going to get from equity risk premium right now. But look, it's 5:28.9. Sorry, Steve, did you want to get a last thought in?
No, I'm not gonna open a whole conversation.
Okay.
But hey, I'm gonna refer to my points to Karen. She's the CIO of new CIO of Bridgewater. She made a good comments about the mispricing in current market between equity and rates, and you guys can take a look. And that's what I'm just gonna say.
All right. Thanks for that, Steve. All right, well, good. We're going to wrap up then this 20-second version of our weekly Wook and Review broadcast now. Just again, to kind of recap, we host these every Friday at 4 p.m. If you want to participate, just be sure that you're following the @Wook Capital handle for this and for any other Twitter Spaces programming that we put on. I noted the watch list is something we now have in effect, and we are looking to recruit bull and bear speakers for some subsequent programming on those securities. So if you are interested, just let me know, DM the handle or DM @Rod or join our Discord, and we can have the conversation there. We continue to be, look, our goal here is we're just trying to learn and grow and have these conversations with people who know more than we do. So sincerely appreciate folks joining these rooms and these spaces and helping to enrich all of our understanding. None of us know everything as much as we may like to believe we do. And we certainly will be wrong again in the future. So please, we look forward to talking to you all again next week. We'll be back Wednesday night with our open mics. We do those 7 o'clock Eastern. We kick those off. So be sure you're following my personal @RodAlsman handle because I host those there. We had a couple thousand people tuned in on Wednesday night. It was a really good one. So hopefully this coming Wednesday will be another solid discussion. So thanks everybody for your interest in Wook Capital Management. We look forward to talking with you again soon. Cheers, everybody. Have a great weekend.
Bye-bye. Thanks, Rod.